Hi, Michael Glennon from Glennon Capital. When you're investing in small caps in the Australian market, you've got three choices. You can invest directly and own a portfolio of shares. You can invest through a unit trust, which you can access through many platforms or through financial advisors, or you can buy shares in the LIC like we operate, GC1. Now, each has got their different merits, but many small cap fund managers who run LICs talk about the benefit of an LIC being that that there's never a freeze on the fund. So the only way that there would be, you wouldn't be able to get out of your investment if there wasn't enough liquidity in the shares, or if the Australian stock market shut down, which would be a very rare event indeed. However, they contrast that with having an investment in a unit trust. And the issue with small companies and unit trusts is if there is a big run of funds and a lot of people want to take their money out, there may not be enough liquidity in the underlying shares that are in the portfolio for everyone to get their cash out. And that forces the manager or the operator of that unit trust to actually freeze redemptions from that product. Now, you might think that that will never happen. However, we have actually seen headlines in the Financial Review this week where one very well-known small cap fund manager has lost their investment team. They've gone off to do something else. That company has actually frozen redemptions on their small cap fund, which means that if you're an investor in that fund, you can't actually get your money out. And so that's an example of one of the disadvantages of having your money in a small cap unit trust as opposed to investing into an LIC where you can sell your shares on market whenever you want. And the only way the company could prevent that happening is if they'd ask the ASX for the stock to be suspended, but it still wouldn't, because it's a captive pool of money, it still wouldn't affect the underlying securities. So for that company that's had to suspend redemptions on their fund, they would actually have to sell all the underlying securities in the portfolio to generate cash to give to clients that were taking their money out. And there's just not enough liquidity in many of those securities. So it can have a detrimental impact for the rest of investors as well, because they're forcing the price down of all of those shares that they've become a forced seller of. They don't necessarily have time to get out in an orderly manner. So that's the worst case situation, and it does happen. We've seen it happen several times over the last few years. And that's why I think it is a very big disadvantage having investment in small companies in a unit trust as opposed to investing through an LIC like GC1. Thanks for watching. I'm Michael Glennon.